Hi, and welcome to today's Engaging for Missouri webinar. I'm Alice Roach from the Division of Applied Social Sciences at the University of Missouri, and I'll be your host today. With each of these 30-minute webinars, we intend to share research-based insights that leaders like you can apply in your own work to benefit and strengthen the state's food and agriculture system, hospitality sector, and communities. For today's webinar, we have Dr. Pat Westhoff, who will present about COVID-19's effects on ag markets and farm income. Before I invite Dr. Westhoff to begin, I want to share a few housekeeping notes. First, we'll close the webinar today with a question and answer session. Those of you who connected to today's webinar via your computer can submit your questions in the chat screen. Just click the chat button that you see at the bottom of your menu, a Zoom menu, and then you can open up that chat screen and submit questions there. If you joined by phone, then you can email me your questions at roacham@missouri.edu. Second, all attendees are muted and may not start their video. Third, if you encounter any technical difficulties, then you can please let me know by either submitting a comment in that chat screen, or you can also send me an email at roacham@missouri.edu, and I'll do my best to help troubleshoot. Fourth, we will make a recorded version of the webinar available to you. You can look for an email from Zoom that shares about where you can access that recording in about a day from now. You can also find an archive of our previous Engaging for Missouri webinars on our division's YouTube page. So now we'll transition to the topic of today's webinar, which is titled COVID-19's Impacts on Ag Markets and Farm Income. Presenting on this topic is Dr. Pat Westhoff, who is the director of MU's Food and Agricultural Policy Research Institute and the Howard Cowden Professor of Agricultural and Applied Economics. So thank you, Pat, for presenting today. If you could please start your video and unmute your microphone, then we can begin your presentation.
Thanks, Alice, for the opportunity today. I very much appreciate you getting this organized. We're going to try to talk through some of the possible impacts of COVID-19 on agricultural markets and farm income. Have a series of slides we'll go through today to talk about that. We're talking about some of the ways in which COVID-19 may affect the ag sector and some early estimates from FAPRI on the possible impacts on crop, livestock, and biofuel markets and on farm income. We just posted a report on our website about an hour ago at www.fapri.missouri.edu. So this opening slide is reminding us, of course, that we've got a lot of different ways that people's buying behavior has been changed in recent weeks. A lot less eating at restaurants, a lot more eating at home, less driving, and of course, major impacts on farm workers and everybody else who's involved in production from beginning to end. So some of the ways in which COVID-19 can affect agricultural markets. On the demand side, of course, more food is being consumed at home, less food is being eaten at restaurants these days. The expected recession is expected to be lowering people's incomes, which will have important effect on their food consumption choices. People are driving less, both individuals in their cars and freight for that matter as well. So that means less demand for fuel, lower prices for fuel, less demand for biofuels. People aren't going to stores as much. That means less sales of clothing, which reduces demand for cotton and other fibers as well. There's also lots of supply chain issues. Labor availability has become a major problem for many parts of the farm sector. We've seen stories just over the weekend about meat processing plants that have workers sick that have caused those plants to shut down, at least temporarily. Border closures, other restrictions on movement of goods can have a big impact, of course, on the cost of getting goods from the farm to the final consumer. And of course, because we're changing what people are demanding at the final level because of these shifts in demand, the products we're making are not the products that people want to buy today. Some are able to buy today. So we have to shift to making things that people can buy at supermarkets versus sort of things that people might be obtaining at restaurants or other institutions. Now, the analysis we're going to talk about today only looks at some of these issues, just the ones in red. So we are going to look at the impacts of lower incomes, the effects of less driving, and the effects of less demand for clothing. That does not, by any stretch of the imagination, mean that the supply chain issues are not important. We expect they are. We know that they are important in the short run, and they could well remain important for quite some time to come, just beyond the scope of the analysis we'll talk about today. So let's jump to some of the assumptions first of all. So again, these are just based on some guesses at this point. This is not based on anybody's hard analysis of what the macroeconomic effects of COVID-19 will be. We would expect with lower incomes that we'll have lower consumer expenditures. So in the baseline, the point of reference for this analysis, real consumer expenditures were going to increase about 2.8% in 2020 compared to 2019. In this scenario, that's reduced by 5%. So instead of increasing by 2.8% in 2020, now real consumer expenditures drop by 2.2%. Expect there to be less spending on food. We expect oil prices to be lower, interest rates to be lower, gasoline use to be reduced by about 10%, and diesel fuel use by about 5% in 2020. We've assumed for purposes of this analysis a V-shaped recession, so a very sharp drop in economic activity in the second quarter and third quarter, perhaps of 2020, but then a recovery would be starting in the latter half of 2020, and then we're back almost to where we started from in 2021. That is a more optimistic outlook than some people have today. I wouldn't want to classify this as being a best case scenario, but certainly far from being a worst case scenario. So jumping to conclusions, now we ran our models of the agricultural sector, crop and livestock, farm income to come up with these numbers. So in 2020, if we started from a scenario where the phase one agreement with China were to go forward, and we were actually trying to implement that agreement with what we thought was the case back in January, with regard to the state of the economy and so on, we expected a price back then of $122 a hundredweight for 5 area direct steers as an indicator of cattle prices. Under this scenario, it's $108 per hundredweight, so a drop of $14 per hundredweight, or about 11.5% in calendar year 2020 relative to the baseline. For hogs, barrels, and gilts, the price declines about 9% this year. For broilers, it's about 8%. For chickens, an 8% drop in chicken prices, and about a 9% drop in milk prices. I draw your attention to the footnote there. The USDA just came out last Friday with its newest estimates of world ag supply and demand around the world and prices for major commodities. Their prices for fed cattle this year were a little higher than in our scenario, but not by much. But they have much lower prices for hogs, for broilers, and for milk. So keep that in mind as we're talking about the rest of the results. If we had the same types of prices USDA is projecting, we'd have been talking about even more negative outcomes for farm income that we're talking about today. On the crop side of things, focusing first of all on the 2020, one marketing this year that we'll be starting with harvest this year and going on for a year after that. Instead of a 370 corn price, looking at 335 instead. You can see the figures there for the other commodities. So it's about an 8%, 9% should say, drop in corn prices in 2020, about a 6.5% drop in soybean prices in 2020, 5% drop in wheat prices, and a 10% drop in cotton prices. The table on the right is also showing you changes in 2019-20 compared to the baseline. That's the year we're in right now. That marketing year started on September 1st of last year for corn and soybeans, on June 1st of last year for wheat, I should say, and in August of last year for cotton. So most of the commodities that were going to be sold during that year have already been sold, and it's hard to change those average prices too much for this marketing year. To get an 8% decline in the 2019-20 price at this point of the season requires prices to be very low the rest of the year. On average about $3.35 a bushel to get to $3.60 a bushel, for example, which was USDA's estimate, even a little bit lower than that to get to our $3.58 that's implied by these figures. So again, very low prices this summer for crop commodities, just as there were on the livestock side. In terms of biofuels, one of the reasons why we saw that drop in corn prices is because of reduced demand for ethanol. So if people are driving less, that means that there's less demand for fuel in general. And the way that the renewable fuel standard works is that it's a certain percentage of overall motor fuel use in this country. So if motor fuel use proves to be less than had been anticipated, that means that the mandate itself also goes down in absolute quantity terms. It's a fixed percentage. So we continue to expect to see people using primarily 10% blends of ethanol. That results in about a 1.4 billion gallon drop in ethanol production in 2020. That's equivalent to something like 500 million bushels of corn, less being used in ethanol plants. Biodiesel demand also drops with less demand for diesel fuel. So jumping to the farm income results then, first I'm going to show you changes in cash receipts. That's the value of what farmers sell during calendar year 2020. Relative to the baseline that assumed the phase one agreement with China, we assume that the COVID-19 will reduce the value of cattle sales this year by $9.6 billion, reduce hog sales by 2.2, poultry by 4.1, dairy by 4.0, other livestock by a small amount, corn by $4.7 billion, soybeans by 2.1, wheat by 0.4, cotton by 0.6, and other crops by $4.1 billion. So significant drops in overall value of what farmers sell in 2020 pretty much across the board. I should note that the other crop category mostly is reflecting things that we don't explicitly model in our systems, so we had to make some assumptions there about the magnitude of the effects that might result for those other crops. Of course, it's not just the receipt side of things that changes, it also has some effects on production expenses. So with lower corn prices, lower soybean meal prices, feed costs declined by $2.8 billion. With lower feeder cattle prices going into feedlots, that reduces purchased livestock expenditures by $3.8 billion. So we compare that to the previous slide, we have to correct the $9.6 billion drop in cattle receipts for this $3.8 billion reduction in feeder cattle receipts. That's part of what's contributing there. Fuel and fertilizer prices declined, so that means $2.2 billion less in fuel and fertilizer costs, and all their production costs we estimate to drop by $2.4 billion in 2020 relative to what would have happened otherwise. So jumping to the bottom line for net farm income, again, we said about $11.9 billion less in crop receipts, $20 billion less in livestock receipts. Some government payments do increase with the lower prices. We'll have some payments under the Agricultural Risk Coverage Program and the Price Loss Coverage Program in 2020 that would not have occurred otherwise. Also, there's marketing loan gains happening today for cotton that would not have happened otherwise. Production expenses that we talked about will decline by $11.3 billion, we estimate. And there's a variety of other things that contribute to net farm income. That's a negative $1.5 billion in total. So taking the sum of all those parts, taking the crop receipts, plus the livestock receipts, plus the government payments, minus the production expense change, plus the change in other net farm income, the net effect overall in producer net farm income in this country is about $20.1 billion. In the baseline that was used for this analysis with a phase 1 agreement implemented, we have projected net farm income to be $106 billion. So a $20.1 billion decline represents a 19% decline in net farm income this year relative to what would have been expected otherwise. To put these estimates in context, I want to emphasize that these estimates are very preliminary and incomplete. We are getting new information by the day that would probably change some of our estimates here. We might have made different assumptions, for example, on the effects on the macroeconomy. Some people think there might be a longer-term recession instead of just a V-shaped recession. So that would change the time path, if you will, on how things might play out. And of course, incredibly importantly, this analysis does not include a lot of the supply chain effects that have been very important, especially in the short run. Some of those, for example, when we have processing plants that can operate, that probably puts further downward pressure on prices for farm commodities. Maybe one of many reasons why USDA was projecting even lower prices than we were projecting for hogs, for chickens, and for milk in the 2020 calendar year. Also should point out that the recently enacted CARES Act provides $9.5 billion for livestock, dairy, specialty crops, and local food systems. So that's money the Secretary of Agriculture has at his discretion to allocate to those sectors. It also provides $14 billion to replenish borrowing authority of the Commodity Credit Corporation. Now, some people just simply add those two numbers together and say that means USDA has $23.5 billion more to spend. It's not quite that simple. The $14 billion in replenished authority only becomes available in July. The actual amount that USDA has to spend between now and July is quite a bit less than that. Number I've seen in the press the last few days is about $6 billion. Actually remains that could be spent between now and July. And it's interesting to note that on Friday, the president was quoted as saying, and Secretary Perdue will be using all the tools at his disposal to develop a program, and very quickly, of at least $16 billion to provide relief for farmers, ranchers, and producers impacted by the coronavirus. So while we don't know any details of what might be in an administration package or how payment rates will be determined, anything like that, there is at least this presidential quote suggesting $16 billion might be possible size for a short-term package that could be coming out relatively soon. So with that, I want to again thank you for this opportunity. There's a view of our FAPRI team that put together this and other reports, and I'll be happy to take whatever questions you might have.
Great, Pat. Thank you. We do have several questions that have come in. And the first is several people have commented on the supply chain challenges that you briefly mentioned there toward the end. For instance, Smithfield indefinitely closed its facility in South Dakota this weekend because of COVID-19. And that facility, according to the company, has about a throughput of 4 to 5% of the U.S. pork production in a given year. So with a facility that size, what's the implication for producers when you see a facility go offline indefinitely?
Yeah, we have a lot of hogs, we have a lot of chickens, we have a lot of other animals moving through the system that need to be marketed. And so if we don't have processing facilities that are open, that means those animals, get backed up. There's less demand for those animals, so it makes even further downward pressure on live animal prices than we would have had otherwise. And again, I would speculate that's one of the reasons why USDA may have been showing even lower prices than we're showing here. They might have been trying to take into account some of those sort of constraints. This preliminary analysis on our part, it does not really fully consider those yet.
Okay. We have another question here. How likely would it be to get an export boost from lower prices to help move product for both livestock products and also grains and oilseeds?
Yeah, so that's a very good question. We struggle with this quite a bit. We did this analysis quickly, and so we did not try to do a full global picture. For purposes of this analysis, we assumed that the net change in U.S. trade would be relatively small. Yes, we'll have lower prices, which would all else equal result in increases in U.S. exports. But on the other hand, other countries are also struggling with COVID-19, also seeing weaker economies, and there's still lots of grain, lots of meat available in the world. So again, we assume those two effects for the purpose of this analysis roughly offset each other, leaving U.S. exports relatively unchanged for the major commodities.
Okay. Another question here about dairy. How do you think dairy farmers would react to a direct payment of about $3 per hundredweight for 3 months? What would be the supply response? Would it just mean more milk from producers?
It depends how that payment is structured. If the payment is tied to what people produce in the next several months, then it's more likely to have a larger impact on supply than if it's just a check that's given to farmers that doesn't depend on what they do in the next several months. Certainly, we have a lot of producers that are struggling right now. And so what can be done to try to address their concerns without forcing markets to go even lower than they already have is an important challenge that USDA is facing right now as they try to design a program.
Okay. So do your estimates in the report released today use the Energy Information Administration short-term energy outlook estimates that were released on April 7th, or do they use the March estimates? Because there were some differences there between those 2 months in terms of estimates.
Yeah, there were some differences there. And again, I don't recall the chapter and verse and precisely what those numbers were off the top of my head. We just did a nice round 10% assumption here. We fully expect we're going to come back in the weeks and months to come and look at other scenarios that may make very different assumptions about what happens to driving habits in the next several months. The longer the shutdown occurs, of course, the larger the effects are going to be. We know in the short run, the effects have been far, far larger than 10%. We're talking much more dramatic declines in the short run in people's driving habits.
Okay. A related question here about fuel. How much consolidation do you foresee in ethanol production, given what we're seeing with the financial stress that you see from some of those processors, ethanol processors?
We have a lot of ethanol plants closed down right now with the sharply lower ethanol prices. We observed in the short run less than $1 a gallon in most of the country now. That is below the cost of production for most producers. So a lot of plants have already shut down, others may shut down in the near future. So whether those plants can get through a period of like this for very long and still remain viable operations is going to be difficult for many of them. And I won't be surprised if there's not further consolidation in the industry.
Okay. So from your perspective, what is the greatest risk to the outlook or these estimates that you're presenting on today? To actually seeing these come to fruition?
Highlighted already, of course. So again, the supply chain stuff we've talked about already. If we have more processors who aren't able to continue their activities because of workers being sick or other problems, that's going to put even further downward pressure on farm level prices. At the same time, it's going to make it more difficult for consumers to obtain the food that they need and want. If we shut down a lot of the nation's meat processing capacity, that's bad for both producers and consumers. The other big thing, of course, is just a question of how long is the current level of shutdown going to continue, and how soon does the economy recover? As I said, we've assumed a relatively V-shaped recovery where things are pretty bad this quarter, but then come back pretty strong and pretty quickly. Other people are suspecting this could last for much longer and could have longer term effects on the overall economy, which means a lot longer term effects on people's ability and interest in buying different types of food.
Great, thank you. A next question is, will prices hold steady in grocery stores?
So it depends upon these supply chain issues. On the one hand, we are seeing lower level farm prices for a lot of commodities, as we've talked about already. But we haven't seen that, of course, at the grocery store, partly because it's costing a lot more to get things from the farm to the consumer because of all these supply chain issues. And indeed, in the short run, we saw big run-ups in prices for certain products, from hamburger to, a variety of other things that people wanted to buy in the short run to restock and to take into account the fact that, we're shifting from buying stuff out away from home to having almost our food consumed at home. I do think that the possibility is there for higher food prices for at least some commodities if those supply chain issues continue to be severe. On the other hand, as time goes on, if we get some of that sorted out, the fact that we've got lower prices at the farm level for many commodities and lower fuel prices as well, could conceivably result in some moderation in food prices in the months ahead once we get through the worst of the immediate crisis.
Okay. This new report didn't touch on any farm balance sheet indicators, but given the estimated drop in net farm income attributed to COVID, is there any concern about what that might do to farm assets and debt, and then the debt to asset ratio?
Yes, we did not report those here today because we need to look at those more carefully, but certainly we would expect a higher debt to asset ratio and other financial problems in the sector. We had challenges in the baseline already, so reducing farm income by $20 billion, can't be a good thing, obviously, for the state of farm finance. A lot of producers are in trouble already, and this is just making it even more severe. Of course, reminder that this analysis does not consider payments that may be made in the months ahead. So those may offset much of the, or at least part of the increase of the reduction in farm income that would otherwise occur.
Okay. Here's a question. As an economist, how challenging is it to make these estimates based on the dramatic shock that the coronavirus has had on global markets?
Yeah, it is. It's incredibly difficult. And in fact, I will tell you right now, some of my staff was probably wondering why we're even trying to do this at this point, given all the uncertainties. By no means would I ever want to claim that this is a definitive view of what's going to happen. We know there's lots of uncertainty and that things will prove very different at the end of the day than what we've got here today. We mostly want to identify what some of the major issues were and make it clear to folks that, the magnitudes are indeed quite large, and make sure that's part of the public discussion, recognizing as we get more information, we'll be able to come with far better estimates what the impacts are.
Great. What is the anticipated impact for next year's food availability and prices?
So again, this depends in large part how these supply chain issues play out. If we're able to get things under a more normal state of doing business in the not terribly distant future, a lot of the short-term concerns may not be that big of a problem in 2021 and beyond. But of course, it does depend on just how the next several months play out on the public health front, how we react to that in terms of restrictions that are put in place, and then how the sector itself was able to respond to probably the most severe challenge it's had in a very, very long time.
Okay. So the report that you released today shared crop price impacts for the 19-20 marketing year were relatively limited, given that most of the production for that marketing year has already been marketed before the crisis unfolded. So can you speak to how risk management is an important tool for producers, particularly when we experience uncertainties like we are right now with coronavirus?
Yeah, it's obviously been a huge issue right now. If people could go back in time, of course, they would have liked to have marketed more of their 2019 crop earlier than they did, and would have marketed some of their 2020 crop in advance as well. Of course, we can't go back in time, so it is going to be a real challenge to make sure people are indeed doing what they can to try to provide some downside risk protection. there's easy tools like crop insurance that most folks are already using to help with that process. We expect that government payments will be part of the process, of course, as well, of trying to provide some protection against the bad things that are happening in the sector right now. But beyond that, I think it's just a usual good advice to people is, don't put all your eggs in one basket. Don't assume you're going to get the market highs. A lot of folks who were trying to get the market highs last year, of course, are now sitting on a lot of grain that don't know what to do with.
Right. We have two questions here that are somewhat related. What's the, or what might be expected from a longer duration shift from restaurant and food service meals to eating at home?
So it's obviously had short-term impacts, as we've seen already, in demand for certain products. I think what's happened in the beef sector is just fascinating. The value of certain cuts has gone up dramatically. The cuts we use for making hamburger and other things that we tend to buy at grocery stores, whereas the value of high-valued steaks, has gone down. So again, until people find ways to adjust their home heating habits to be more like what they might have eaten outside of the home, we're going to see continued challenges in trying to get the sector to provide the goods that people want at a price that they can afford.
Sure. Some media reports have suggested that the coronavirus pandemic may trigger an economic depression depending upon how expeditiously we can control this virus. So could you do a quick compare and contrast about what makes an economic downturn a depression versus a recession?
So I'm not sure exactly what the dividing line is between the two. I mean, most people refer to the 2009 recession as the Great Recession. So about as bad as you can be and still consider something a recession. A lot of folks are worried that at least in the short term here, the decline in economic activity in the second quarter of 2020 may be rivaling anything that's happened since the Great Depression of the 1930s. So if it were to last for a length of time, we're talking about a more serious situation that may take a long time for people to dig out of. People are having to borrow money just to pay for basic needs right now. And if a lot of people are unemployed for a very long period of time, short of there being a very massive amount of government spending for a long time to come, it can be very tough to dig ourselves back out of this.
So going back to the question about risk management and marketing, what percentage of the 2019 corn and soybean crops have not been marketed?
I don't have the numbers in front of me right now, but it's probably something like a quarter of the 2019 crops of corn and beans have yet to be marketed at this point. In the case of wheat, of course, the wheat marketing year ends just a few weeks from now. So the vast majority of the wheat that's going to be sold this year has already been sold.
Okay. And then you sort of responded to this earlier, but I just want to get your thoughts again. Considering the impacts you estimated, on-farm financial stress has the potential to be pretty widespread. So what do you recommend to producers who are looking for solutions to alleviate financial stress?
Again, make sure they're taking advantage of what help is available to them, whether it's by talking to their banker, whether it's making sure that if they have an opportunity to participate in various types of government programs, they do take advantage of those. But also the usual advice of making sure that you're keeping your costs down wherever it's possible to do so without negatively impacting your ability to produce and sell what you need to produce and sell. And in general, just being as careful as you can about things. This is a tough time. It's a tough time for a lot of people, and so trying to get through this will be hard for many people.
Great. Well, thank you, Pat, for sharing today. We'll go ahead and close for today. Thank you to our audience, too. When you exit Zoom, a post-webinar survey will load in your browser. Please consider responding to that, as we'll use the results to improve the webinar experience and brainstorm future webinar topics. Again, you should receive a recorded version of today's webinar via email within about a day from now. Our next Engaging for Missouri webinar is on Wednesday, and we will have representatives from MU's Center for Applied Research and Engagement Systems, or CARES, share about All Things Missouri, which is a data and mapping platform used to support planning, community assessment, and grant reporting. Thank you again for joining us, and have a great Monday. Thank you, Pat.
Appreciate the opportunity, Alex. Great job.